All right, let's continue what we did last class. So you have these two life insurance policies and you want to try to compare them. It gets really tough to do, but there is a way to do it. Whole life policies, we talked about, it's the premium, but there's also the cash value. How do you adjust for that? It's really hard to compare whole life to universal life to variable universal life. They're very different. But if you're looking at two whole life policies, could you compare them? So here's the standard the industry has. It has two approaches. One's called a net cost approach, and then the interest adjusted. The interest adjusted really is the only one that makes any sense, especially if you're doing something over 20, 30 years. But let's just do an example just so you can see, because these are reported in the press, and it's not a bad way to compare two companies. So let's say you have $100,000 insurance policy. And we're going to compare, this is historical, all right? So the key here is we're looking historically. So you might say, what does that mean to me? Because I can't buy historical, I can buy in the future. So essentially what you're trying to do is look at companies, how they've done it historically, and assume they're going to do as equally well relatively to others going forward. So you're really just looking at past performance to try to give you some sense of the future. I know you're not supposed to do that, but in insurance products, that's probably not a bad idea. So this product pays dividends, so it's participating. It has a cash value at the end of year 3 and at the end of year 20. And then you're paying premiums. So on the traditional net cost approach, nothing's adjusted for time value money except for the cash value. The cash value is the actual number. So by year 3, this policy would have paid $196 in dividends. By year 20, it would have paid you $10,000. That sounds pretty impressive, but these policies do tend to pay pretty high dividends. Your cash value at the end of year 3 is $29.63. At the end of year 10 or 20, it's $39,000. So you receive the dividends and the cash value is yours. So that's how much you're receiving. How much did you pay? Well, after year 3, you would have paid $6,561. You would have received $31.59. So your net cost would have been $3,402. So essentially the dividends and the cash value is cutting your costs in half. But by year 20, look at this. You would have received $46,387. You would only pay $43,000. So essentially, you got insurance for free. You received $2,647 more. Is that what you really received? Well, no, it's 20 years. What are you missing? The time value money. So obviously you didn't get this for free because you have time value money, but that's the approach. And then what you say is, okay, how much is this? And we tend to do this with life insurance. We do everything on a per 1,000 basis. So you can compare different products. You can compare a $500,000 policy to a $300,000 policy. So how many thousands are there in 100,000? Well, there's 100. So you take the 3,402 and divide it by 100. It's costing you $34.02 for every $100,000 of insurance that you buy. Over here, you're getting paid $26.47. And then we say, well, this is over 3 years. Let's divide that by 3. So essentially, we're paying $11.34 each year for every $1,000 of insurance we're getting. And you can compare that $11.34 to another company's product just to see who's more expensive. And when you do that, you account for dividends, you account for cash value, and you account for premiums. You don't have to account for the face value because you're getting the same. This is on a per $1,000 basis, so you're comparing like to like. The problem with this is that you don't have time value money. So let's just bring in the time value money. So it's the exact same policy, but the $196, if you future value that in year 3, that's actually $200. That doesn't sound like much of an adjustment because you probably didn't get much dividends in year 1, maybe none in year 2, maybe just very little in year 2. And maybe most of the dividends came in year 3, so there's not much time value. But if you look over 20 years, there's a huge difference. $10,487. The future value of that is $14,119. But then you look at the cash values. What do you notice about the cash values? They're exactly the same. Why? Because the cash value is the future value. That is what you will have at the end of year 3, at the end of year 20. So we don't need to adjust that. So all we're doing is getting a little extra cash time value for those dividends. Essentially what they're saying here, we're assuming 5%. So if you'd gotten those dividends and you had invested them at 5%, at the end of year 3, they would have been worth $200. All right, see what you're doing there, pretty straightforward. The biggest difference is going to be on the premiums. If instead of paying these premiums, you had invested them at $5, how much would you have had at the end of year 3? So that premium goes from 65.61 up to 7,239, and even bigger, the premiums paid over 20 years goes from 43,000. That jumps up to $75,000. So now your net cost is 4,000 for 3 years. You compare that to not being adjusted, it goes from 3,402 to 476, but over 20 years, it's a huge difference. Instead of you making 2647, it's actually going to cost you 5,019, and that's the time value money, which over 20 years at 5%, that's massive. Now we adjust that for every $1,000 of insurance, and then to adjust it for time. To adjust it for time, you have to actually, you can't just divide by 3. You have to divide by the future value interest factor of annuity, 3.31. Y'all remember how to do that from your 3013 class. This is actually a very good number. This policy, if you had bought it, would have cost you $12.31 per year for every $1,000 of insurance. That's a pretty good number to compare to other companies' products, especially for whole life, because we've accounted for essentially everything that there is for the product. The dividends, the cash value, the premiums, everything's in it. Now, if you did universal life, it doesn't work so well because you got a moving creditor rate. You do variable universal life, you got the stock market, it gets really messy. But this is a pretty good number to use. Now, how would I use these numbers? Well, what AM Best used to do, remember that magazine I told you, AM Best? I don't know if they still do it or not. I should go and look. But what they used to do is they did this twice. They would do this analysis on an illustrated basis, what the firm thought was going to happen over the next 20 years. And they would do it on an actual basis the prior 20 years. And what I found really was interesting on the prospective basis, what firms were forecasting, the firms at the top of the list were never the firms at the top of the list when you looked at the history. So the firms at the top of the list going forward never got you what they said they were going to get you. They were never as good as they said. And so what I was looking for were firms that consistently ranked at the top of the list when you look at the history. They may not look good on prospectus, on their illustrations, but they looked really good on their actuals, what they actually did. That was the firms I was looking for. The other thing I was looking for were the firms that ranked really high on illustrations and ranked really low on their actuals. Those were the firms that were, essentially lying to you. Now, why has it maybe changed is that the regulators have put really strong restrictions on illustrations, and they may not allow you to even show illustrations anymore. So that data may not be available. I found it really fascinating. I worked for USAA. USAA was always middle of the pack on the illustrations and always real close to the top on actuals. And I thought that's good. That means they're really honest on the illustrations. And when it comes to the actual performance, they rank really high. The other thing is, how consistent were those two? You can't actually do that. You can't go back and get the illustrations that they showed 20 years ago and compare. I guess if you went back and looked through old AM Best, maybe you could find them. But pretty interesting information. If they don't do the illustrations anymore, if all you have is actual history, I think most firms are pretty consistent over time. I know working at USAA, their goal was to always be in the top 25%, and they were pretty adamant about that. And so, firms have these goals. So, if that's their goal, then they're probably going to be fairly consistent over time. It's possible a firm's struggling. They've done really well in the past, but they're struggling, so they're going to have to just be less competitive going forward. That's possible. But most firms aren't going to be, let their competition go all over the place. They're probably going to have some goals on that. So I would like this number in my hip pocket, how a firm actually does historically versus competitors. And I would probably trust those firms that are at the top of that list It's a good number, especially the interest adjusted one. The nice thing about the interest adjusted is you're going to use the same interest rate for every company. So they can't say, hey, we use a 6% discount rate, we use a 4%. Everybody's got to use the same, you're using the same discount rate to compare them all. So it's a pretty comparable number over time. I should Google this and see if this is reported on the internet somewhere. If anyone's on the internet, you want to try that interest adjusted net surrender cost index for whole life and just see if something comes up. It would be interesting. I should have done that. All right, let's get into this exam question. So every exam I have usually has one squirrely question, and this is the squirrely question on exam 1. You might think that ethics question was the squirrely question on exam 1, but this one's even squirrelier. Okay, so let's get down to the basics of should you buy term or should you buy permanent insurance? And in the late 70s, this guy, Art Williams, came along and he preached buy term and invest the difference. So essentially what he was saying was term is cheaper. So buy term, you're going to have some extra money, put that extra money into the bond or stock market. And if you do that, you'll have your term insurance for the time you need it. And then when the term runs out, you got this wonderful portfolio that's going to have more money in it than you would have had with life insurance anyway. That's his argument. I love the argument. I actually buy his argument. I don't like his company, but I'll buy his argument. So I buy his argument, but I wouldn't buy it from him. I buy it from somebody else, but that's his argument. Anybody know what firm Art Williams was the founder of? Have y'all heard of this firm? Primerica. So it has a long history. It got bought by Travelers, and then Travelers got bought by Citibank, and then Citibank spun off Primerica. I don't know where they are now. It's been somewhat of a strange story. So Primerica's main claim to fame, beyond the buy term and invest the difference, their main claim to fame is their sales force. They had the most. Have y'all seen like the some of these multi-level marketing companies, some of their sales conferences, how energized the people are? It's almost like a cult sometimes. Sorry if I'm stepping on toes, but what's Amway? Y'all heard of Amway? I know this guy who was an Amway salesman. And some of y'all may do it too. I don't know. I think it's a little bit of a pyramid scheme, but boy, he was adamant. When I told him I wasn't interested, he almost punched me in the face. He's like, sorry, I'm not interested. I don't need soap right now. Well, Primerica had salespeople that energized. They really believed in it. They sold it hard, and they weren't your traditional life insurance people. They were school teachers, policemen, you know, people from just everyday life. And they were so passionate that they were good salespeople. They had people back and listening to them. They could really sell well. So he created a really huge revolution in the insurance industry, him by himself, mainly because he had this really strong sales force. The industry tended to hate this guy. They really badmouthed him quite a bit. He did get into some legal problems. I don't know what exactly he was accused of, but he had some legal problems. You can find all that on Wikipedia. So the industry was buying what was selling whole life pretty strongly in the 60s and 70s. At the end of the 70s, interest rates were high, so that was killing them, that disintermediation. And you have Art Williams come around and say, you don't need whole life anyway, just buy term. You'll be just as well off. So the industry is getting hit from both sides here. And so what I did is I went to Art Williams, Primerica's website, and I just listed their arguments for why you should buy term and invest the difference. I didn't organize it. I didn't put it in any particular priority. And then I found the textbook. I think I mentioned this last class. The textbook I have used in this class, but I don't use it anymore. It's not a very good textbook, I don't think. But he was very pro-industry, and he argued for, he very biased, argued permanent over term in his book. So I just listed his arguments. What you're going to find when you have to answer this question on the exam is I didn't do you any favors here. There's a lot of redundancy and overlap. So you're going to have to sit and look at these two arguments, and you have to organize it. That's part of the critical thinking, is you give me a good organized answer. So if I were you, I would look at these arguments and try to organize them in a way that makes some sense. Now you're going to find out that I'm more on that side of the argument. So I'll give you my biases. All right. So I'm definitely on that side of the argument. However, I do think there's a really important place for whole life. My mom stood about whole life. That policy made a lot of sense. Unfortunately, she bought universal life, but a whole life policy would have made a lot of sense. Term really didn't make sense because she needed insurance in case my father passed away, his pension goes away. She needed that. And that could have happened when she was in her 70s or her 80s or her 90s. Whenever he passed away, she needed life insurance. Whole life made perfect sense in that scenario. They could not have bought time invested difference because my mom would have spent the difference. She had all her charity projects. My mom loves giving money away. It would have never worked. Whole life was perfect. So we'll talk about that. There is an argument for whole life in that situation. All right. So the first argument that they make is essentially what I told you about that textbook, that book I found in the library, where he said, why would you combine your insurance with your savings? You don't do that with auto insurance. You don't do that with health insurance. Why would you do that with life insurance? If you need insurance, buy insurance. If you need to save for retirement, save for retirement. No reason to combine those two things in one product. That makes sense. The second argument is just kind of obvious. Term insurance is cheaper when you're young, which is when you need it. That's true. 10-year level insurance might be $50 a month. Whole life might be $250, $300 a month for the same face. It is materially cheaper when you're young. When you're old, that definitely changes. So obviously, if it's cheaper, that gives you more money to invest. Pretty duh, that's obvious. Now, I made a mistake sometimes in here in putting the counter argument here. I shouldn't have done that. But I just put it here is studies have been done on this. And when Art Williams said, buy the term $50 a month, and that $200 you're not paying for the whole life, invest that. Studies have shown like 80% of Americans bought term and then spent the difference. They didn't invest the difference. So obviously, if you do that, this whole argument doesn't work. You have more control over your investment program. Now, one argument that the other book made about that is that Americans are not trained in investment management. I'm going to make the argument down here. I think this counter argument is completely bogus. You can go to Vanguard, you can go to Fidelity. There's plenty of professional investors out there that charge almost nothing. Vanguard especially. You know, you go to Vanguard, you can buy a mutual fund for 1 basis point, 0.0001. You know, they're charging you almost nothing. And in fact, Vanguard has mutual funds where what they charge you is less than what they make in securities lending. So essentially, you're going to make the index plus 2 basis points or something. So you don't need professional investment management. You can do that yourself very easily by just going to a large investment firm. At the time he wrote his website page, this was true. The next argument he makes, I think, is really important is you buy term when you're young and it's cheap because that's when you need term. That's when you have dependents. That's when you have human capital. Why buy life insurance for after your retirement? So, you know, that doesn't make sense. So buy term when you need it, when you have dependents. It's at lowest cost. My strongest argument, this is, I think, y'all already know this is my argument. So,
you can drop the phone.
Sorry.
Can you give Josh his phone, please?
Is he talking to me or not? Sorry. We need someone to do a YouTube of all Zoom situations that have come over time. I remember the one time my cat jumped on my head during a Zoom. It was like, okay, you went outside, but I'm not taking you outside right now. All right. So this is my key argument. Y'all know this is absolutely the most important thing. Term is very simple, very easy to compare, makes comparison shopping. There's really 2 things in that argument. It makes comparison shopping very, very, very simple. You saw why we had to go through with whole life, with the index, index surrender cost index. It's so much easier to term. You absolutely just buy the cheapest product. It really is simple. Yeah, that is a strong argument. His next argument, I don't buy this one at all. He says, if you need money with life insurance, you have to borrow from your life insurance policy, and that affects how much coverage you had. Whereas if you have a mutual fund, you can just take money out of your mutual fund. Well, the problem with that argument is if you borrow against your life insurance, that's true. You get your $100,000 insurance, but then you have to pay back the loan. But you're in the same place. You take the money out of your investment, you're still out of that 40,000. So I don't buy that argument. The other problem is if you take money out of your investment account, you can create tax issues. With life insurance, if you borrow from your insurance policy, there's no tax issues as long as you pay it back. So life insurance actually from a tax standpoint probably is an easier way to get cash if you have an emergency than it is from especially if you're putting money into your IRA. Taking money out of an IRA can create tax penalties. So, you gotta be careful at that. So I don't buy his argument. I actually think it's actually quite easy to take money out of the cash value of your life insurance. You can borrow against it. It's pretty easy to do without any tax penalties whatsoever. Now here he's comparing the whole life, and it is true whole life pays really, really low rates. And he's saying, hey, put your money in the stock market. Your whole life's paying you 3%. You can invest in the stock market and make 8, 9, 10%. Why not do that? The insurance industry said, yeah, but now we have universal life. We're more competitive. We're not as bad as we used to be. You see how I'm mixing all the arguments up. So you have to really, really organize this. And the life insurance industry is also going to state, yeah, we don't pay as high as the stock market, but we're not as risky as the stock market. So, you get lower returns, but you don't take as much risk. So there's some argument to that. And then the last argument Art Williams made on his website was, if you insure your entire life, you're buying insurance protection when you don't have human capital. So why are you buying insurance for years you don't need it? So obviously people do need insurance after they retire. I'll just give you my mom's example of, someone dies and their pension goes away, you need it for that. You might need insurance for your estate, taxes, your probate, all those kind of things that happen in life. So there are some arguments, but he's arguing once your income stops, you don't need insurance. There's some truth to that, but there are other needs. All right, so those were the 9 arguments he had on his website. Now, I don't know if we go to Primerica today. What would be out there? Name most trusted by whom? That's interesting. Concepts. High cost of waiting, pay yourself first, theory decreasing responsibility, rule of 72. I don't know if they have that on the power compound, debt stacking. I don't know what they mean by that. Term life, there's their term life page. What's the big deal? What kind of life insurance should you buy? Term and pure protection like fire. Term sufficient for most families. Least expensive so they're still making that argument. Isn't group insurance through work enough? How much life insurance do you need? They apparently have a calculator on here. So their website has definitely changed. I don't see buy term and invest in difference anymore. So I don't think they're not making that argument anymore. You almost don't even notice that they're a life insurance company, do you? Because that's where they make most of their money, is on the investment side. Mutual funds. I'm scared to even look at their mutual funds. Managed investments. Wait, sorry, I don't want to get on a tangent. I hate this part of our industry. Boy, we charge a lot for very, very little. So there's the 9 arguments they made back then. They're not making those arguments now because they essentially won the argument, and they're just competing like another company. All right, what did this textbook say about permanent? So like I said, they say, yeah, we do pay less on our products. That's because our investments are lower risk. But that ignores modern portfolio theory. So if you're buying a whole life policy and you're 22 years old, your cash value is essentially going 100% into a bond. How many 20-year-olds should have 100% of their investments in a bond? Doesn't make a lot of sense. It's a fairly low risk investment. What if you live too long and you get insurance in later years? So there are reasons to have insurance in later years. So whole life is a perfect solution for that. So you see where I'm coming from is buy term for most things, but then there are some reasons to buy a little bit of whole life, maybe a $50,000, $100,000 policy. That makes sense. Buying that from your employer doesn't make sense because you're not going to be working the rest of your life. So whole life is a very good product. Makes a lot of sense. The argument Art Williams would make is, well, if you buy term and invest a difference, you'll have a portfolio that handle those needs. There's some truth to that if you invest the difference. Their next argument, again, makes no sense today. He's saying, hey, let the insurance company manage your portfolio. We got professional investors here. Well, Vanguard, Fidelity, those firms are going to do that for you. You don't really need that. Very easy. Liquidity. So I do buy this argument. If you need money, it is actually very easy to get money out of your cash value. You just borrow money. It's very simple, no tax. Now, my biggest argument for permanent is this forced savings argument. Permanent insurance, especially whole life, forces you to save money. It gives you a cash value that you might, if you didn't invest, you would not have at all. There's a lot of people, if their premium is $250, they're going to pay $250 and they're just going to keep doing it the rest of their life. They got, at least they have something to show for it at the end. Now, can the mutual fund industry create forced savings? And a lot of them do this dollar cost average where they take $50 out of your checking account every month. You kind of set it and forget about it. Your 401k plan kind of does that for you. Is it as good as this? You know, you have to just say, see, Art Williams' argument of buy term and invest a difference. If you don't have that kind of forced savings set up, then you probably want invest a difference, and a lot of people didn't do that. Now, my mom and dad, they had universal life, so they had a premium of $250, but they only had to pay the $50. But if you sent them a bill for $250, they paid the $250. It was just their habit or way they did things. So it really did work very, very well for them. And if they hadn't done that, I'm sure they would have spent the difference. And then you do need life insurance later in life because the term insurance will get really, really expensive. All right, so those are the arguments. So how do you organize that? So let me tell you my bottom line. I had a friend of mine, he was getting married. He was in the military, still in the military. And he had someone send him a whole life or permanent insurance product. And he asked me, should I buy this? And so this is the thing I said, well, you can buy that product, or you can buy 20-year, 30-year term, and you can invest a difference in premiums. And so I set this up for him. A friend of mine named Ken, he's really excited. I'm talking about him in my class. So he thought it was pretty cool. He's retired now. And I don't even know what he did. I have no clue what he did. But here's what I told him. And I used his actual numbers. So it really comes down to who can do better, the insurance company or you. And that's what I told him. Who's going to do better? So I took his numbers and I built these 4 scenarios. This first one, I said, you have a choice between buying this whole life or buying 30-year term, and you invest the difference in premiums at 3%. And then the last scenario I ran was you buy this whole life policy or you buy the 30-year term. If you buy the 30-year term, you invest a difference at 8.58%. I'll show you where I got that number. Okay, so on the exam, you're going to have to draw a couple of these charts and explain the charts to me. All right. So let's talk about the first one. So the first one, the blue line is whole life. So you buy a whole life policy and you pay the premium. The question is, what do you get if you die? So if you buy a $250,000 policy whole life, if you die at 42, what do you get? $250,000. What if you die at 87? 250. Very straightforward. Right? So the term policy, if you die at 42, what do you get? Why do you get this orange line and not the blue line? So if you die, what does the life insurance company pay you? $250,000. So why do you get more than 250? Yeah, so if your policy was $50 for term and $250 for whole life, you have $200 you can invest at 3%. So this difference here is that portfolio you had invested at 3%. So if you die at 42, you'll be better off having bought the term and invested the difference. Because you buy the whole life, the most you can get is 250. You buy the term and invest the difference, you get 250 plus your investment portfolio. What happens at age 54? Term insurance expires. So what do you have left there? You just have whatever your portfolio is. Now, the nice thing is going forward, you're not investing just the $200. You're also investing the $50 you're paying for the term. So you have that extra amount to invest, but it's going to take you a while. So if you die at age 60, the whole life's going to pay you $250. If you bought the term, you no longer have term insurance, so you don't get anything from your insurance company, but you got about $100,000 saved up. At 78, what happens? The whole life pays you $250, but if you had the term that expired several years ago, your portfolio is worth about $250. You're kind of indifferent. What if you die at 96? There you get no term insurance because it expired, but your portfolio is now worth $500,000. Which is the better policy? And the answer is yes. Yes, it is. Because it depends. You don't really know. If you know for sure you can't make more than 3%, then there are some years you're going to be worse off with the term. If you have a spouse that if your spouse dies, your pension goes away, you've got some problems in here. Because if your spouse passes away here, you're only going to have $100,000. Is that going to be enough to replace their pension? But if your spouse dies out here, you're probably better off investing the difference. Y'all see how this is working? Okay, and I use real life numbers all the way through here. What if you could make 6%? Here's a lot more skewed. So here at 57, you're a little worse off, but not much. So if you're pretty sure you can make 6%, would you ever buy the whole life? Be better off just buy the term and invest the difference. Now, who can make 6%? That's pretty hard, especially if you're buying bonds. That's a pretty high standard. But if you're in stocks, maybe you think you can make 6% over the long term. If you put it in your Roth IRA, there's no tax consequences. So that's good. They're both tax-free, right? Your Roth and your insurance are both tax-free. So that's good. So not much difference. Just a few years of difference there. And then when you get out here, it's convex, right? Because the compounding interest makes a huge difference. That's assuming you invested a difference. Who's disciplined enough to keep investing in a difference? Well, hopefully some people are, and that works. And then the last scenario I did is I did a break even. What is it? What return you have to be so the term is always at least as well or better off than the whole life, and that's 858. 858 is a really hard number to get. I don't think anyone thinks they can make 8.58% over the next 40, 50 years. That's probably impossible. So, and probably in most cases, there are some scenarios where the whole life is going to be better, at least for a few years. But most of the time, the term is probably going to be better. Your worst case was you only make 3%. In that case, you got about a decade and a half where the term is a little bit better. And the whole life is a little bit better, although the gap closes pretty quickly. So you got, I guess about 20 years there of difference. Could you buy a 50-year level term? Well, if you do 50-year level term, the premium's probably not the same as the whole life because you're essentially insuring your whole life. So then the premium is probably going to be 250 and you're not going to have any difference at all. 30 years is probably about as far as you go. 30-year was all I could find. I couldn't find any 35, 40-year out there. Would this change if you did a 20-year term? Yeah, the premium would be less, but you'd probably discover that a 30-year term and a 20-year term, the premiums really wouldn't be that radically different. We'll have to look online and price them. Maybe I'll do that next class. We'll actually do some real life pricing out here and see the difference. 10-year term probably would be significantly cheaper than the 30-year term those, but maybe you're talking $30 instead of $50. It gives you an extra $20 to invest. Over 20 years, that's going to be pretty sizable and it's going to add up, but who knows? So you'd have to kind of assess each one of those. The problem with the 10-year is at year 9, if you're really sick at year 9, you're not going to be able to buy another 10-year term policy. So then, you're going to be in a lot of trouble. So, you have to, this is not easy. There's no obvious answer in any of this. If this picture was earned 2%, it would be pretty obvious, right? You're pretty sure you can make 2%. And if that's going to put you ahead, just buy the term and then, you can probably get better than 2%, you'd be better off. In the late 70s, early 80s, that was the case. Treasuries were paying 12, 13%. You could obviously make 12, 13% by buying a 30-year treasury, and whole life was paying 3 or 4%. It was a no-brainer back then. Yeah, just buy term and invest the difference. But that's not the case today. So you got to be able to explain these on the exam. So, read through the discussion. You got to put it into your own words. But it really does come down to an investment decision. And then how much risk do you want to take? Can you take these? If you think you can make 4%, can you handle that slight differences? 4% doesn't look that bad. There's a few years where you're a little bit worse off, but it's not disaster. Just tell your spouse, hey, make sure you don't die in here. Or if they do die, maybe you could do a weekend at Bernie's and hide them away for a few years. Who knows? That would probably be a felony. So I'm just joking. All right. Questions on that? Let's see what comes up here first. U.S. News, generally speaking, term policies are cheaper. Generally speaking, is that really generally speaking? If you buy them at the same time, term is always going to be cheaper. It's unless you're buying from two different companies and one's really, really a bad company. New York Life, what do you think New York Life's going to say? They make more money on permanent. They'd rather sell permanent. Let's see what kind of argument I like New York Life. If you're a finance major, boy, I'd love to work for New York Life. Very impressive investment portfolio. Is a great choice when your protection needs are expected to be high for a period of time, then drop back. In these situations, term coverage. The disadvantage, boy, look at all those. I would give you some definite bonus points on exam 1 if you went out and actually gave me some new arguments. I'd be thrilled if you do that. Term provides a death benefit only when term expires, so there's protection. Once a contract expires, that's it. So if you die 3 seconds later, unless you can get the coroner to lie on the death certificate, and you're not going to be there to have it happen, so you got to get your family to do that. That'd be really frustrating. Has that ever happened before? Someone with life insurance policy dies at 12:01 the next morning. It's probably happened before. Purchasing term insurance is often compared to renting a house. When you rent, you get the full and immediate use of the house. I don't like that argument. Does that really seem true to you? That's a stretch to me. There's a very real dangers that you could sever help. Now, this is true for term. If you do 30-year term, you're essentially saying you don't care because you're going to build up such a big portfolio at the end of the 30 years, you're going to be essentially self-insuring. 10-year term, this is absolutely true. If you get diagnosed with something after 9 years, then yeah, you've got a problem. So what does that mean with term insurance? You need to keep repricing it. So I'd recommend if you buy 10-year level term, I would be looking at it every 3 years. You can buy another 10-year policy 3 years from now, at almost the same premium. I would extend. So you should let the 10-year policy lapse and buy a new 10-year term. And there were times there quite frequently, like the 10-year term was getting cheaper. It should get cheaper over time because you're aging, but it was actually getting cheaper because mortality was coming down. In that case, you should compare other companies. So if you're paying $45 a month and 3 years later, you can pay $42 a month and get an extra 3 years, you should always do that every single time. You get that extension because of this health risk. It's definitely an issue. Since premiums increase at the end of the term, the long-term cost of term can be burdensome. That's why term policy coverage conversion privilege is important. I'm not sure the conversion privilege is important because it's going to make you pay more. I think what they're arguing is it's really dangerous to let the 10-year policy go the full 10 years. And that's absolutely true. And what I'm not saying, it's not an issue, but the key here is how frequently you look at the term. So don't look at your term at year 9. That's way too late. You have to be really pretty aggressive on this, and they're not addressing that you should be looking at this every 3 years. Permanent, the cash value, look at all the positives on the permanent. Where's the negative on the permanent? The disadvantages, where's the disadvantages on permanent? Wow, it disappeared. Can you tell where they make most of their money? So cash value provides lifelong insurance protection. Despite higher initial premium, cash value can be less expensive than term in the long run. Can be, it's unlikely to be. While whole life can eliminate the problem of future insurability, whole life, you're insured for your whole life no matter what. Yeah. You can tell where they make their money. That's where they push it. It's a good company. I like New York Life. There's Bankrate. Bankrate should not have a horse in this race. So they should be objective. So the pros and cons, Value Penguin, I don't know who that is. There's Minnesota.gov. What are they gonna say? You have YouTube videos. Dave Ramsey, what do you think he says? So y'all can watch him. I'm not a big Dave Ramsey fan, but I'm gonna guess he's a term guy. But if he pushes perm, I'm gonna guess that he's getting some kickback for pushing perm. Not that he would ever get a kickback, but that would be my argument. So my guess, just knowing him, that he's probably pushing term, but I don't know for sure. He may be giving you the objective one. The objective one would probably be most people term is sufficient. That's all you need. But these are the cases where perm makes a lot of sense. But then he's going to have to get into the issue of universal life, variable universal life. My guess is he hates those products, but I don't know for sure. I've never seen him argue those. So there's plenty of stuff out there on these products, not just what I have here. So if you want to enhance your answer, you can certainly find some more stuff to bring into this. Okay. I think what we'll do on Thursday, I'm going to go ahead and start annuities because I really want to get into equity-linked annuities. But on Thursday, I think what I want to do is log into my USAA account and do that when I'm not on Zoom. So I don't give you all my, my hundreds of dollars I have saved up. But USAA is a really good calculator. And what I want to do is compare a few things. And y'all might have some others y'all want to talk about. So let's. So one thing is 10-year versus 20-year term. I want to look at that. How much more is a 20-year? 20 year is going to cost you more because it's not just because it's covering you more, but it's because you're aging, you're getting older. So that's an important one. I want to look at 10-year, 20-year versus whole life. And that's going to be a really, really stark difference. And then also want to look at U-Life. Now, which is going to be cheaper, U-Life or whole life? Y'all remember that one? We talked about it last class. Let's see. Whole life is cheaper? We'll see. I'm going to argue U-Life's going to be cheaper because the crediting rate's going to be higher. Because the whole life, they got to give you a fixed credit rate for the whole life of the policy, so they're going to undersell that a little bit. If they're making 5% of their portfolio, they're not sure they're going to make 5% for others if they go there. Universal Life has the advantage of what? They can change that rate. So they can offer you a lower rate today because they're making more, but if they don't make as much, they can increase that rate in the future. Like with my mom, going from like $250 a month to $1,600 a month. So I'm going to argue, Michael, you might be right. We'll see. We'll try it. But I'm going to argue Life are probably cheaper. I want to look at men versus women. That's a nice thing on the USA site. Even though I'm loaded on the site, I can change my age. I can change, male or female. I can do all kinds of things there. I want to look at different ages. What does it cost for a term for a 20? Well, y'all are 22-year-old. We'll put 22 in there. 20-year-old versus a really old person like me, like a 60-year-old. How much difference is it? It's going to be fairly starkly different. We could, if we wanted to, even compare 27 versus 22 male, because that's where the driving comes in. 22-year-old men are much worse drivers, so maybe their insurance might be actually about the same, even a little more expensive than a 27-year-old when they get married and become boring drivers. If y'all can think of other things to compare in there, we can certainly do that. But those are the ones I want to compare, and I can do all these on USA, but I'll probably have, the problem is I'm running from my other class, so it's really hard for me to get all that set up. So maybe I'll let y'all talk a little at the beginning of class as I get it all set up. And once I get it all set up, then we'll do some comparisons. Or maybe I'll do the comparisons in advance and I'll just show you the screens. But can y'all think of anything else that would be of interest here? Are you curious? What about a 10-year-old? Would that be curious? You can buy insurance on a 10-year-old. How cheap do you think it is? Are 10-year-olds less risky than 27-year-olds? And how much of a difference does it make? I mean, it might be interesting. I'd be curious. A 10-year-old male is going to have 6 years not driving and 4 years driving. Do you think that has an impact? Would you want to sell life insurance on a 17-year-old? It's still a pretty low risk. It's higher risk than, say, a 22-year-old, maybe a 27-year-old. It's not massive. We're not talking about a 40% chance versus a 1% chance. We're talking 1.6% chance versus 1.2, something like that, but it's statistically significant. I don't know. Y'all let me know if y'all can think of any others. What are you curious about? I don't know what age y'all are. I'm assuming you're all 22, but you might all be 22, but I'm assuming none of y'all are 60. I'm assuming I'm the oldest person in here. Miles. So I find it interesting. I don't know what the answers are because I haven't done this in a year. So I don't know how much it's changed and I can't remember the answers. So maybe I'll do it in advance. So we have all the printed screens and you can see what's going on. I think what I'll do here, the question here might be, what do you think the difference is percentage-wise, men versus women at 22 versus at 60? Where do you think the bigger difference would be? Do men and women live about the same age in their 20s? I remember well, I don't think I told you all this story, but I remember reading an article about UK that there's 8 80-year-old women for every one 80-year-old man. always say when I turn 80, I'm just going to move to the UK. I'll be gross outnumbered, as ugly as I am. I'll still be a really good prospect. 8-to-1, where does that start shifting? That's probably not true at 60, is it? It's not 8-to-1 at 60. It's maybe 3-to-1 at 70. I don't know, but 8-to-1, that's a pretty stark difference. That's probably a much bigger difference than it is for 20-year-olds, I would guess. Right? There's not 8 30-year-olds women for every one a 30-year-old man in the UK. So it's pretty stark. How the Queen was 96. How old was it Philip? What was his name? How old was he when he passed away? Not quite 96, but he was up there though, wasn't he? So I mean, it is a fairly stark difference. So we'll see. Is that changing too? We know the mortality of men has worsened more than women here recently. So as the difference got even starker. So it's interesting. We'll see some articles. I think I have an article I'm going to show y'all. I thought I had it in the notes, but I don't see it in here. I might do it when we talk about the mortality table, so we'll get into it. So I do have an article here in talks about men versus women. So insurance companies, they have mortality tables for men, they have mortality tables for women. I don't know if y'all be interested in this. What if I started smoking? Y'all have a guess how much a smoker pays for life insurance versus a non-smoker? Can I put that? I don't know if I can put that on USA system or not. My guess is I probably can. Y'all think that's material? And does that make a difference between 22-year-olds versus 60? Would you rather sell 10-year level term to a smoking 20-year-old or to a smoking 60-year-old? So did the actuaries know all this? You better believe it. They have data out of, all over the place on this stuff. We have plenty of data on all of these kind of things. So I'll email this to myself. Anybody think of anything else?
What about like syndromes that give you higher chances of like skin cancer or stuff like that?
I don't know if I can do that. I think the way USA, because there's a limit to what you can plug in. I think what USA's site is, here's our premium we think we would charge you. Now you got to fill out the application and we'll tell you. And I think that's where they get all this stuff. So I don't think you can actually do that. I do think I can put smoking in there. We'll see. I'll look at everything I have as a choice and I'll let y'all see what's there. Anything else y'all can think of? I'm always curious because to me it's I trust actuaries. I know they're very, very good at this, and I know they have good data. And it's far more reliable on the life insurance side than it is on the auto insurance side because the world doesn't change all that drastically. So to me, it's really fascinating stuff. All right. So let's talk annuities, and then we'll come back to life insurance on Thursday. I was talking to a lady on Sundays, a lady in my church. She wanted help with financial planning. And she got really confused in the discussion. She said you had an annuity. So, oh, you have an annuity? She said, yeah, I've got an annuity. It cost me $1,600 a month. And so, okay, so what kind of annuity did she have? Deferred annuity or immediate annuity? So she had a deferred annuity. That's to me not an annuity. Your paper one is not over that type of annuity. Your paper one's over an immediate annuity, one that pays you money. So she had one annuity that she was paying money to. Then she had another annuity that was paying her money. That was an immediate annuity. And she was confused because they were both annuities. To me, the first one is not an annuity. So we're going to talk about accumulation annuities and payout annuities. But in my mind, an accumulation annuity is not an annuity. That's just an investment. It's like any other investment. You're just paying money. Why do we call that annuity? Because you're creating an investment to create annuity to pay you money. We've mixed those two terms, and boy, is it confusing. It really is confusing. So she had a payout annuity that was paying her about $250 a month. She has Social Security. What is Social Security? That's an annuity. It's paying her income. But then she was investing into what was called a deferred annuity to build up until she reaches age 70 and starts taking it out. So it got really confusing, and I could see her confusion because we're using the same term for two very, very different things. So this industry uses annuity for both of those terms. When you go to a mutual fund company, they don't sell you annuities, but you might buy an IRA. What is an IRA? We use the word for annuity for that, but that's not an annuity. That's an investment as well because of the tax law. The tax law uses that term. So it gets really confusing. To me, the insurance company, when it does the accumulation period is really just selling an investment. The payout annuity is where the insurance industry really has its strength because it's the only industry that can sell that product, a product that pays you out for the rest of your life. Actually, the annuity she had, let me tell you the annuity she had. Actually, I said it wrong. She bought an annuity from UTSA that paid her $1,600 a month. It did pay her, so I got it backwards. It paid her $600 a month until she turned age 72, and then it stopped paying her. So that wasn't an annuity either. That was just, she paid $100,000 and they were paying her $1,600 a month for 10 years, and then it stopped paying her. That's not an annuity either. So I thought that's kind of interesting. And so she's like, okay, what do I do when that runs out? All I have is my Social Security. That's not enough. So I said, what other assets do you have? So what other asset do you think she had? Her house. Thank goodness, right? She's got her house. So that's where we're really working with her. How much could you sell this house for? And if you put that into an annuity, how much income would that pay you? And that would give you enough money to move into a good senior living place. That's the kind of math she's got to do now. She's got something to work with because she's got a house. Housing prices are falling. I didn't tell her that, but housing prices are falling. Probably in San Antonio, not too bad. So you can see this is really, really critically important stuff. Do you see for her how the life insurance industry might provide her something she can't get anywhere else? If they say, hey, we'll give you, and I actually went on the UTSA site and we plugged in different numbers. What if you sell your house for $300,000 and you put $100,000 into annuity? Oh, they'll pay you this much. And then it gets pretty simple because if they're going to pay her $700, if she puts $100,000 into annuity, we're pretty sure if she does $200,000, they're going to pay her $1,400. It really is very scalable. So we could sit and do that kind of math. And that's what I told her. This is what she's got to put together so we can sit down and figure out what she's going to do. She's already paid off her house, so she gets to live there just for property taxes. That's kind of nice, but it's a huge house. Does she really need this massive house? And could she sell it and go into a senior living? So what's the problem with senior living? Well, what if she starts having memory problems? That senior living goes from $3,000 a month to $6,000 a month. How does she handle that? Does she buy a long-term care product? That's the kind of stuff we're looking at. It's a little tricky because we may not find a solution that's going to work in all situations. And she may just have to take some risk. So I'm just take the risk that I don't end up in assisted living for 10 years of my life. Can you do that? If you don't have any choice, you don't have any choice. All right. So these are very difficult questions that you're going to have with your parents probably in about 20 years, maybe. Are your parents, what, 40 something? Are you going to have this conversation with them when they turn 60? Are you the hear no evil, see no evil? Can you have this conversation with your parents? Are your parents thinking, oh, my solution is I move in with my kids? If they're thinking that, do you want to have that conversation before they move in with you? Or is your solution, I've got siblings, they'll take care of it? What if you're the highest earning sibling of all your, how many of y'all are going to be the highest earning of all your siblings? No hands need to be shown, but if that's the case, you're the one they're going to be turning to. So these are tough conversations to have, extremely important conversations to have. If you have no clue about your parents' retirement situation, you need to start, how do you bring up that subject? Have y'all figured that out? So, hey, mom and dad, how much am I part of your retirement plan? I'm just curious. Have y'all seen these people who build houses where they have the mother-in-law house? Y'all seen those? I go out in Helotes. 3 or 4 of the houses have the mother-in-law houses, and their mother-in-law houses are far better than what I live in. Let me tell you, those are nice houses. This one guy, he's a retired fireman, and I don't know if they pay firemen, but his mother-in-law house, that thing is wonderful. My word, it's probably 2,500 square feet. It's on the side of a mountain. It's got this beautiful open window glass. I'm like, when your mother-in-law passes away, can I rent out next door to you there? That's really, really nice. My word. So anyway, so these are important decisions. You've already studied this. People are living longer, so this is becoming a much bigger issue. Your parents might live into their 90s. People are retiring earlier, although if your parents aren't prepared for retirement, they're probably going to have to work later. That's what this lady I'm helping, that's what she's having to do, but she's not working full-time. She's working part-time. So she's getting a little bit of income. So she's got income and she's going to get Social Security. I can't remember exactly the numbers, but there's a fun point she'll get both. We got the baby boomer bulge, which is going to cause some issues. So what are your solutions? Solution is you just don't retire. You just keep working. A lot of people don't want to do that. The interesting thing is the people that are least prepared for retirement, what kind of jobs do they have? Are these people who love their jobs generally? Generally not. They're maybe they're in retail or doing stuff. Maybe they have the jobs that you guys have now because you're college students and you're really good students because you don't want to do that the rest of your life. But that is one solution. You retire later. Social Security is one solution, but it usually doesn't cover enough for most people. And there's some question about its financial viability. Annuities is what we're going to talk about. You build just some massive portfolio. How much do you really need to retire comfortably? People used to say $1 million. If you can spend 4%, $1 million times 4%, that's 40,000. Can you live comfortably on 40,000 a year? If your Social Security is 20,000, can you live comfortably on 60,000 a year? You got to take taxes out of that. Well, I was talking with this lady is, what are you spending your money on? Let's figure that out. So I said, get your checking account statement out, get your credit card statement out. Let's look where you're spending your money. If you're spending $300 a month at Starbucks, maybe you need to buy a coffee maker. You have to give that up. If you don't know that, you can't make those kind of decisions. And some people said, you know what, I'm not ready, but the government's not going to have me live on the streets. So they'll bail me out somehow. I don't know how they're going to bail me out, but they'll bail me out somehow. What does the government do for you if you're indigent? There is housing for people in those situations, but is that what you really want to rely on? So, you have these type of issues. Assisted living. What happens when you run out of wealth? What does Social Security and Medicare provide for assisted living? You may want to study that if you're really not prepared. That's maybe what this lady has to say is, you know what? I can buy an annuity. It's going to cover my senior living, senior center, but it won't cover my assisted living. I'm just going to rely on Medicare to do that. Well, let's sit and see what Medicare is actually going to provide. Let's figure that out before you make that decision. That would be important. Y'all see where financial planners are actually pretty valuable. I think financial planners overcharge for a lot of stuff that's not that valuable, but here's where they can add a lot of value. These are important questions. This is where people should be sitting down and saying, hey, I'll pay you $1,000, $2,000. You help me figure all this out. I'm doing it for this lady for free, but she probably should go to someone who has a little more knowledge of Social Security and Medicare because that's not my area of expertise. What are you guys doing? This is probably what you're doing. We'll look at this later. How much do you actually need to set aside? I'm going to show you a spreadsheet that will say that. You're going to be pretty shocked at how much it is. What's the real key to this is to start early. That's probably the most important thing, start early. But there's a lot of these models are saying you need to put 10, 20% of your income away in retirement. Can you really put 10, 20% of your income away? That's a lot of money for a lot of people. So Social Security's out there, pension plans are going away. Oh, there's that chart. You know, I told you I had this chart. Here it is right here. I knew I put it in here somewhere. So pension plans are dying. It's all 401k plans. So we're shifting more and more to 401ks, your personal savings. And then the life insurance industry steps in and they said, we've got a product for you, but actually they don't say that. One thing with your Article 3 and 4, they both argue the insurance industry has a really great product, but people aren't buying it. One thing I don't think they say is that the industry is not selling it. If you go on any life insurance company's website, we could even do that with New York Life. You can look and see how hard is it to find their immediate annuities, and it's not what we offer. There it is, Income Now. So there it is. That's the product. You click on that. Guaranteed immediate income annuities. So they have it. But how hard are they actually pushing this product? Their sales reps, how much of it? I doubt you're going to go to any of these insurance companies and that they're above the banner. Main thing they're promoting is going to be the immediate annuities. It's going to be something else. Part of the problem is they don't make a lot of money on this product. It's not one of their biggest profitable products. So they don't push it from that standpoint. So I think part of the problem with this industry is it just doesn't want to sell this. And I think they're making a mistake because I think this is the product consumers need, and I think they could work this out. So we'll start here next class. I don't want to get in the middle of it. I mean, well, the next class, we're going to do some more life insurance stuff. All right. So a few admins things. I got an email this week from a firm wanting to hire a financial planner, CFP type. So if anyone's interested in that, send me an email. I'll send it over to you. I can't remember the firm. It's a bigger firm, but I can't remember the name of it. Second thing is Oliver Wyman, which is a major actuarial firm. They emailed me. What actuaries we have in Win-Win? You're an actuary, right? Isaiah, are you actuary? Who else is actuary? Here, I know Julissa and can't remember her. Maria. So I got to figure out who's in charge of y'all's group. I thought Maria had some charge. I'll try to email her, but Oliver Wyman wants to treat y'all to lunch on October 12th. I don't know if y'all are free around lunchtime. He said 12:30, so I don't know if that worked. We could try to do it in the FSC. So Oliver Wyman, that's a great company. They do have actuarial science. And one of the ladies in this class, she got a good job with them. In fact, she emailed me about how much what we covered in the class really helps. So that was kind of encouraging. But she's the one that reached out to us. And another one of the people in this email is also a UTSA alum. So they're looking for UTSA. They're UTSA alums. They like the UTSA people they've hired. So how many of you actuaries might be interested? Would you be, Isaiah, you would win? All right. Maria, right?
Yes.
You're actuary as well? Yes. Okay, so let me repeat it one last time here. So October 12th, Isaiah win-win, Maria, maybe Julissa's actuary as well. Huh?
She is.
So Oliver Wyman wants to treat y'all to lunch here on campus, October 12th around 12:30. If y'all need it earlier or later, let me know. I'll try to email all y'all on this, but I'd like to get out to the broader group as well. So if any of y'all have access to like the actual club or the math club, whatever y'all have, let me know. I need to give them a head count here pretty soon. So if I'll try to email y'all tomorrow and get a sense, but if y'all can help me get it out. Do y'all have any classes where it's all actuaries and y'all all talk to each other? So I don't even know who your professor rep is, because the lady I used to work with, she retired. So I don't know who.
Robert Anderson.
Keating, okay.
analysis and stuff like that. I'm just gonna get some more statistics.
Okay. All right, I'll try to, yeah, if we can somehow find out who these are, but Oliver Wyman is a wonderful company. They really are an exceptional company and be a great place to start as an actuary, I think. So, so I'll finalize that in the next few days. So be watching for that. All right, let me do one quick attendance. Dylan. 1, 2, 3. You're William. Okay. Stefan is probably working on his paper in my other class. Angela, Victoria. I don't think many other people came in. Ezekiel, he's working on the other class. Gary. Okay. So I did go out and get some pricing. Unfortunately, USA changed their site, so I couldn't do all the stuff I wanted to do. It's kind of frustrating, but I did find a little information. So for $100,000 base for a 22-year-old male, 10-year, 20-year, and 25-year term for a non-smoker, between 10 and 20 years, there wasn't much difference. $9 versus $10. So you might as well just buy the 20-year term, an extra dollar. Or if you do $500,000 a year, an extra $5 a month, but just not that much, pretty inexpensive. For a smoker, it was a little tougher. The bottom end of the range wasn't much different, but the upper end of the range was much, much higher for a smoker. So you can see it's more than double. $276 a year versus $108. So it makes a big difference in the smoker. For female, the difference was only $1. And for smoking, the difference was, so it's cheaper for women, definitely, but not radically so when you're young. Then I did my age, 60-year-olds. So for a 20-year-old, it's $9. For a 60-year-old, it's $29. What do you notice when it jumps to 20-year term? Because they don't think, what's the chance I'm going to make it to 80? So it jumps a bunch. And then a 25-year term, it's much, much, much higher. It's like 4 times higher. And then I did an 80-year-old, 60-year-old smoking. What I thought was interesting for 60-year-olds that smoke, it didn't make that much difference. I guess they figured if you're a smoker and you made it to 60, then somehow you're immune. And then I did 80-year-old woman, and they didn't let me do 20-year term. So 10 is the best you could do, but $3,000 a year. But even then, an 80-year-old woman for $100,000, there's a pretty high probability she's going to die before she makes it to 90. And yet for 10 years, she'd only pay $30,000. So even then, that seemed kind of cheap to me. So I was kind of surprised it was that low. We can look at the mortality table when we get there. And then whole life for me was about $2,900 a year versus for 25 year is only 1,000. So, some of these numbers seem a little bizarre to me. Whole life is 2,800, but 25-year term was 1,000. It makes me tempted to, kind of depends on why you're buying the insurance and what you need it for. There's a good chance I'm not going to make it to 85. And yet the whole life is much, much, much steeper. So, some of these numbers to me from an actuarial standpoint seem a little unusual. But the ranges were now, I did not do the health thing. I could have done that, but the questions were a little bizarre. I wasn't sure exactly how to put them in. They had a few questions. The biggest question they had was, did your mom or dad die of these diseases before they were this age? And then they said, if your mom died of a disease that only affects women and you're a man, you can ignore that question. So they had some kind of bizarre questions. I don't know how much that would have impacted it. But I mean, look how cheap this is. I wish I should have done a whole life. That's where I messed up. I should have done a whole life for a 22-year-old just to see the difference. That would have been interesting. But you can see at a 60-year-old, you know, it's almost 10 times, whole life is almost 10 times more expensive. So yeah, that's my one fault. I should have looked at a whole life here. But USA used to let me add more people and add more people. So these numbers I had actually get from another website. Is a little more generic, and they didn't let me do whole life, so it was just frustrating. I couldn't do the numbers I wanted to do. But that gets in the argument. Term is significantly cheaper, even for 25-year term. This person is going to be 47. If you can make it 25 years and have a really good investment portfolio sitting there so that you can insure yourself, you know, that may be the way to go. And really what you might do is you might buy the 25-year term, and then 5 years from now, reprice it if you're still healthy, and you could probably get another 5 years, and it probably wouldn't cost you it'd almost be exactly the same. So you could probably get it out to your 55th, 60th birthday without too much trouble, without it costing you that much. All right. What we'll probably do is we'll do some of this ourselves when we do the pricing, and we'll see what the actual numbers are, because we can do this ourselves. We got the tables. So, all right. So let's get into annuities, and then we'll get into some controversy today with equity-linked annuities. So a life insurance annuity, it's protecting you from living too long, provides periodic payments. There's two periods. There's the accumulation period, which to me is just really isn't life insurance. It's just an investment, but it has huge tax benefits. The thing that life insurance companies do during the accumulation period that banks and investment firms don't do, that if you die during the accumulation period, you'll get some type of life insurance. You'll get some kind of benefit. Sometimes what they'll say is that would have a stated benefit, but if it's variable type of annuities, what they'll say, and we'll actually have to talk about this, is they'll say, hey, if the stock market crashed, well, at least give you your money back. So essentially what they'll do is they'll offset, the death benefit is they'll offset the market crashing. I'm going to show you one guy that figured out a way he could play the system with that. Pretty ingenious fellow. But the death benefit there is just to make sure that you didn't lose money. The biggest advantage here is the tax treatment. You might say, well, I can get a Roth IRA from an investment firm. I can get a traditional IRA from an investment firm. That's true. But once you hit those maxes, that's the most they can do for you. With life insurance, once you hit the max on the Roth IRA, you can do an annuity and you get tax deferral. And so life insurance companies, they can't give you the Roth treatment where you get tax-free forever, or the traditional where you get a tax deduction, but you can get tremendous tax deferral that you can't get from an investment firm, you can't get from a bank. So that is a huge benefit. I've been taking advantage of that with an annuity I've purchased that gives me really competitive rates, and I just keep deferring it, and it is really pretty impressive. I want to focus more on the payout side, but we will come back to the accumulation when we talk about equity-linked annuities. So a payout annuity pays out until you die. You can get a period certain. So if you want to make sure, hey, I don't want to buy this annuity and then I die next week and I don't get any of my money back. So you can say, hey, give me at least 10 years. A temporary life annuity pay. We're going to ignore that because no one really sells that anymore. So any guarantees you put on this is going to reduce your monthly income. So this one, I'm actually going to try to price this as well. I'll do this one more time. This one, my USA site actually was quite powerful. So they seem to have a lot of bells and whistles on the annuity side that they took away from the life insurance side. But I know it works because I did it this last weekend with that lady I was helping. So we can see what happens to your monthly annuity payment if you put a 10-year certain on it, because obviously it's going to bring it down. If there's no life contingency, then it's really not a life insurance product. It's just an investment. The annuitant is the one whose life governs how long this thing pays out. There is anti-selection on the annuities. So insurance company knows that healthy people buy annuities, unhealthy people don't. So there's actually different mortality tables for life insurance and annuities. People live longer in annuity tables, they die faster in life insurance tables. How do you classify annuities? Now this gets, well, I remember when I started in a life insurance company, this was really confusing because you have the accountants, they have their own classifications. You have the sales reps, they have their own classifications, and then the IRS has their classifications. So it gets really confusing, but I'm going to give you kind of the generic here. And annuities can be individual annuities or they can be group annuities. There are annuities that are sold to employers as a benefit to their employees, and they buy those from life insurance companies and they put a bunch of people into a group. Annuities can be fixed or variable. If they're fixed, then they just pay some stated rate every month. If they're variable, the policyholder decides, just like the variable life, the policyholder decides and they take that risk. Variable annuities are just like variable life. They're regulated by the SEC. You have to have dual license to be able to sell those. So we're going to talk about the variable annuity and the death benefit because just to show you how important is that. Y'all have heard of Hartford Life, haven't you? Or Hartford Insurance Company, y'all have heard of Hartford. So Hartford sells auto insurance and homeowners insurance and commercial insurance. But they also sell life insurance. So here's the 2008 crisis. What do you notice with Hartford? Their stock went from 103 to, I can't even see the bottom of that. 103, whatever that is down there. That's like an 80-90% drop. The stock market didn't drop that much. So why did Hartford drop so much? Why did this auto insurer, homeowners insurer, commercial insurance company drop so much? It's because of their life insurance subsidiary, and it's because of their variable products. So, and because of the death benefits on their variable products, if you can believe that. So that's, I mean, aren't you glad you didn't own Hartford stock back then? That's a pretty hefty drop. So this whole thing, I used to, when I taught this, is like, yeah, these annuities, they have death benefits, but they're not important. And then 2008 happened and it almost destroyed Hartford, that one thing. So it can be really, really important. Annuities can be immediate or deferred. An immediate annuity is the payout annuity for Article 3 and 4 that you're reading about. That's what an immediate annuity is. So you give them $100,000, they start paying you premiums. A deferred annuity is you're investing, you're giving them money investing, and at some point you retire, you start getting money back. So the deferred annuity is building for retirement. The immediate annuity is taking money out for the retirement. Annuities can be single premium or an installment. Deferred annuities are usually an installment or single premium. An immediate annuity is going to be single premium usually. You're not going to pay them $500 a month and then they pay you $600 a month. That doesn't make any sense. So an immediate annuity, you give them $100,000 and they start paying you income. You don't pay them anything else. So immediate annuities, immediate annuities are always single premium. Deferred annuities can be single premium or they can be installment. So the typical way these work. So an SPDA is a single premium deferred annuity. So you can walk in and say, here's $100,000. I want you to invest it for the next 20 years and I'll come take it out. That'd be a single premium deferred annuity. A SPIA, single premium immediate annuity, you walk in, you give them $100,000, and then next month they start giving you $500 a month. The most likely scenario here is you have a husband and wife and one of them passes away. They have life insurance. The surviving spouse takes that life insurance and goes buys a SPIA. So maybe the spouse that passed away had a pension plan, And when they passed away, that pension plan went away, but they had life insurance. You then take that life insurance and you try to replicate that pension plan. Right, that's a SPDA. So SPDA and SPIA. Annuities can be single or joint life. I don't think joint life annuities are as common on the deferred side, but on the immediate side, yeah, it's pretty common to have a SPIA that can be joint life. You can have pure life annuities, or you can have period certain annuities. So pure annuity is once you die, you don't get anything else. That's going to give you the highest monthly income. A period certain, if you die, then it keeps making payments to your beneficiaries for some period of time. Now, market value adjusted annuity, these are way insurance companies protect themselves. So what it says is, buy your annuity from us. This is a deferred annuity we're talking about. Buy your annuity from us. And if interest rates move in a way that's really disadvantageous and you want to take your money out and go somewhere else that's better, you can do that. But we have the right to adjust your market value to adjust the fact that interest rates moved against us. If you're buying one of these, you hate this. But rating agencies love these because it protects the companies from that adverse selection. It protects them essentially from a run on the bank. You remember the disintermediation? This protects them from that disintermediation, because if you want to take your money out and go to a bank, you're going to pay a penalty for that because interest rates have moved. And then from an IRS standpoint, you have qualified and non-qualified annuity. A qualified annuity has really special treatment for the IRS. If it's a Roth IRA, you invest in it and you never have to pay tax on it ever. If it's a traditional IRA, you buy it, you get a tax deduction today, but eventually you got to pay tax at the end. That's incredible tax treatment. The IRS will definitely limit that. If it's a non-qualified, you don't get those two benefits, but you do get tax deferral, which is kind of nice. So y'all know what Roth IRA, don't y'all? So Roth IRA, what tax deduction do you get today if you start a Roth IRA today? None at all. So what's the advantage there? Tax-free for the rest of your life. So this is an important, Michael, I'm kind of curious what your firm recommends. I think most firms are recommending the Roth, aren't they? Isn't that pretty traditional? I mean, pretty common. So a Roth, no deduction today, but never taxed. Traditional deduction today, tax deferred, tax at 70.5. So when you turn 70.5, you have to start taking money out. How much is taxed? Well, what is taxed is the IRS is going to give you maybe 16 years or whatever. They're going to assume some life expectancy. You have to take that much out every year. You have to meet those. If you don't understand that, the company's going to do that for you. They're going to make all those calculations. They're going to help you with that. And so when you take that out, you have to pay tax on the part. So it's not 100% taxable. It's not like you turn 70.5, you have to pay tax on the entire thing, but you do have to take out a certain amount out that's going to be taxable. And so, but you got a deduction today. So which would you rather do? Well, if you do the traditional, you have more money to invest today because you get a tax deduction, so you get that, but you're going to eventually have to pay tax. What's the better answer? It depends on Congress. So could Congress make Roth IRAs taxable in the future? They absolutely could do that. They want to change the tax laws and say Roth IRAs that you thought were tax-free for the rest of your life, they're now taxable. There's nothing that keeps them from doing that. Would you be mad if they did that? Yeah, you'd be really, really mad if they did that, but they could do that. That might be the advantage of a traditional IRA because you're going to have to pay tax anyway. What's the chances they're going to do that? Does the US have a deficit issue at all? So what they're likely to do is means test it. They say, well, if you have more than this in your Roth, then it's going to be, or whatever. So depends on Congress, depends on the stock market. So a lot of people say Roth is better because you can get all these massive gains from the stock market. You never have to pay tax on it. And that's really want to go. But if the US stock market doesn't do very well, you would have much preferred to have had the traditional. So if you know what Congress is going to do and what the stock market's going to do, you know which one of these to buy. You don't know the answer to either one of those. You know, the Roth is probably the one most people say. It is kind of nice to have something that you don't have to ever worry about tax and just do it. So that's kind of nice. What about your 401k? You get a tax deduction today. Essentially you do, right? Because you get pre-tax earnings. That's really nice, isn't it? You get tax deferral. Is it taxable in the future? Tax in the future. I don't know what the age there. Maybe it's 70 and a half as well. 72. All right. So you get. Is that true for traditional as well? Wow, 72. That's kind of nice. Okay. How much of it is taxable? The entire thing, right? Because you never pay tax on it to begin with. So you're not just taxed on your investment gains, you're taxed on every single part of it. So you got to be careful of that with the 401k. That's massive. So how do you make these decisions? It's almost an impossible stochastic model to set up because you make certain assumptions about future tax rates, what the stock market's going to do, what Congress is going to do. They could change the 72 again. The nice thing with the Roth, you don't care about the 70, 72 and all. Our IRS is like, hey, it's not taxable anyway. We almost don't care. So you got a lot more flexibility with the Roth. With the traditional, there are tax penalties. I don't know tax law. It used to be 10%. I don't know if that's still a penalty, but there's tax penalty. You take the money out early. So you have to look at all of these things and be really, really cautious about what you're doing. The 401k, there's tax penalties there, but you can borrow against your 401k. And as long as you pay it back, there's not a tax penalty. So this is where your financial planner adds value. Don't come to me for tax advice. I've got a CPA, but I don't give tax advice because all of my tax training I got in 1985. I don't know if the IRS has changed the rules since 1985, but my guess is they probably have. There's probably at least one thing that's changed. So don't come to me. So that's where a financial planner can add tremendous value. Y'all have CPAs at your firm, Michael? You don't do taxes. Yeah. So that you can add tremendous value on the tax side. This is quite complex. And then you add in executive plans. And there you need a tax advisor and an actuary to be able to figure out what to do. Because I remember the actuary at USAA, he'd get all the execs together to explain. He talked to us for an hour, and at the end, everybody's like, what are we supposed to do? I don't understand any of that. They would all just call Michael and say, Michael, tell me what, not this Michael, but the Michael actuary we had. Say, Michael, just tell me what to do. And Michael was like, well, if you want to do that, and they're like, no, don't say if. Just tell me what to do. Should I defer? Should I just, it's incredibly complicated. So these are things to think about. When the IRS giveth, what else did they do? The IRS taketh away. I don't know how to spell taketh. So the IRS is not your friend. Yeah, they're giving you these wonderful tax benefits. They're going to penalize if you do it wrong. They're going to force you to stay in there forever and ever and ever. If you don't want to stay, it's just, so be very, very careful. You say these are wonderful, wonderful things. They are, but the IRS is going to make you pay handsomely if you mess this up. So very careful. That's really true on the executive plans. the IRS is particularly harsh on executive plans. And a lot of you, probably all of y'all are going to be officers of some company that's going to have an executive plan. The rules are just hideous. They're just hideous. So be really, really careful on these things. Don't set these things up without thinking. Now, the thing they have now, which I think is really interesting, is 401k Roth. So you can actually do a 401k Roth. So if you want to buy, your 401k, but you don't want the tax advantage today, you can set your 401k. That's an incredibly complicated tax decision to make. So, but you probably don't want to hire a tax attorney because you're probably not rich right now. You don't want a tax attorney. So, well, it's good luck with that. All right, let's talk equity-linked annuity, index annuities. It's hard for me to think of a worse product than this. Maybe heroin or some other meth-based, some drug out there. I don't know. This is just, to me, my least favorite product. But if your firm sells it, your firm probably has the one good equity index annuity out there. It was introduced as part of the stock market shooting up and doing really, really well. The insurance industry wasn't the first to try this. The banking industry tried this and it was a flop. But for some reason, it worked in insurance and didn't work in banking, but banking did try this. It's a product that's really more of an investment than it is an actuarial product. So it's really not an insurance product. It is a deferred annuity. So it's part of the accumulation stage. It is not, even though it looks more like an investment than an insurance product, it is not an SEC regulated product, although there was an attempt, a very strong attempt to get the SEC to regulate these, but they didn't. They came so close. It's essentially a combination of an investment and a derivatives product. My argument is, if you like this, and I love the idea. I'm a big fan. In fact, I have a blog that recommends to actually do this very thing. But my recommendation, if you like this, do it yourself. Don't use the insurance company to do it, because if the insurance company does it, they're going to charge you so many fees. You're going to come out way behind. So you can create this thing yourself. We're actually going to do it in this class. The real issue here is the marketing. The marketing is often explained in terms of get all the returns of the stock market without the risk, which is totally bogus. It's not true, and I'm going to show you that, but that's why some people buy it. And then, my pet peeve with this industry is complexity, and this is about as complex as you can get. Although my friend who had this, he had not an equity-linked annuity, he had an equity-linked universal life, which is just off the charts. So the SEC asked, should we regulate this as an investment, the way we do variable products? You notice the word variable is not in the title. So what the SEC asks is, well, is this insurance or is it an investment? So there's a rule 151 safe harbor that if you're insurance and not an investment, you're exempt from federal antitrust regulations. You're exempt from SEC regulations if you fall under the safe harbor. So how does the SEC decide whether or not you're exempt? Their first requirement is this firm regulated by the insurance or banking regulators? Will only insurance companies sell this? So 100%, yes, they are regulated. So that one's a piece of cake. The second question they ask is, how is the investment risk allocated? So with the variable products, 100% of investment risk goes to the policyholder. And so the SEC say, hey, if it's all going to the policyholder, it's an investment. The SEC should regulate this. With equity-linked annuities, it's kind of questionable. The insurance company sets it up and they hedge it. They're essentially passing it on to the policyholder, but it's not as straightforward as it is with the variable product. So one thing they look at, is there a separate account? So a separate account is the insurance company sets up the product, but there's some mutual fund that the money goes into. It's really separate from the insurance company. That's one thing. So equity-linked annuities are not set up like that. They're not set up in separate mutual funds, separate trusts. So the second thing to ask is, does this product have any guarantees? Like if you die early, we give you all your premiums back. Those type of things. Equity annuities do have those type of guarantees that you would not see in an investment product like from Fidelity or someone. They do have that. And it needs to have some type of minimum crediting rate, and equity annuities do that to the extent that it's required for their product, although it's a really small part of the product. So for the most part, they meet this, although there is some question about the allocation investment risk. The third requirement they look at, and they're not saying you have to meet all of these to be exempt, or it's essentially, this is the criteria they look at, but it's a little subjective. And I think the third one is where the SEC is the most concerned about this product, is how is it marketed? Is it marketed as an insurance product, or is it marketed as an investment product? And this is where the SEC says this is really marketed as an investment product. The sales pitches are really sound more like they're working for Fidelity than it sounds like they're working for MetLife. How is the sales force trained? How does the company monitor its sales force? What are the distribution channels? Are they insurance distribution channels, or are they investment distribution channels? What are the primary competing products to this? Are they mainly mutual funds, or are they mainly insurance products, deferred annuities? I think that's where the insurance industry is at its weakest. They really don't do well there. And then requirement 4 is there's any mortality risk there, and that's not as like critical. So there was a law before Congress that SEC was going to regulate these products. It looked like a done deal. It was part of what was it part of? Was it? I can't remember what it was part of. Oh, I think it's part of Dodd-Frank. Y'all remember Dodd-Frank? Come out of 2008. It was a done deal. It was going to be done. And then the insurance industry, they've got good lobbyists. They went after it strong, and they got it taken out at the last second. So it looked like a done deal, and then it went away. And the insurance industry was really glad they got rid of that requirement. So let's look at it. All right. So we're going to go through this. So what we're going to do is I'm going to read this article. We're going to go through this article. This is on Blackboard. And then we're going to do the math of equity-linked annuities. All right. Which is the only math question on exam 1. So you have one. It's a fairly straightforward math question. Any of y'all took my P&C class, we did securitized cat bonds. Some of the math is very similar. I got this from the SLCG. I forget what that stands for, but it's in the footnote somewhere. It's an old paper, but trust me, it has not changed. I've seen these products recently, and it has not changed that much. So at the time they wrote this article, equity annuities was a huge part of the insurance industry's profitability. And even bigger is a huge part of the commissions the sales reps were making. It's regulated by the states, not by the SEC. You can see their argument here is these products are way too complicated, and I absolutely agree with them on that. I think they're way too complicated. Now, here's their argument. We estimate that between 15 to 20% of the premium paid by investors is a transfer of wealth from unsophisticated investors to insurance companies and their sales force. So you can see they come right out front. They don't like this product. They think it's a transfer of wealth. Insurance companies that add trivial insurance benefits. We'll talk about how trivial they are in a major market downside, but disadvantageous tax treatment. We'll talk about those in this article. And exorbitant costs. And sell them. But here they're talking about variable annuities. So they don't like variable annuities. But what he's saying is all those horrible things about variable annuities, they also apply to equity-linked annuities, but even worse. So far they've been free of the securities regulation. There are people in this industry that want this product regulated because they just think it's a horrible product and they think it's making their industry look bad. But so far, the people selling this have won the argument. There's no way to know what you're buying on these products. That's the argument they're making. You can't determine what you're actually paying, what it's actually costing you. It's just too complex. It's so complex, it's virtually impossible, even for the people selling them, to evaluate them. I'm going to talk about how you would actually evaluate them, and this article does some of that for you. However, the salespeople can calculate the commission pretty quickly. That's not difficult for them. It's a 10% commission, and they're selling a $500,000 policy. They know what their commission is. $50,000. That's pretty easy to calculate. Here's the marketing. They say potentially misleading marketing claims. Any recommendation to liquidate securities purchased equity-linked annuity requires a determination that the equity-linked annuity was suitable. That word suitable is extremely important. Suitable is a fairly weak standard versus fiduciary. So you say, hey, it's suitable. You just have to show that it's conceivable for this person to buy this product. NASD applies the principle that broker dealers will no longer be allowed to sell current equity-linked annuities. So NASD has issues with this product. They say they're too complicated for the majority of brokers and retail investors to understand. The complicated structures allow insurance companies to sell the investments, which are much more costly and much less liquid than available alternative investments. So this article does not like them, but the industry loves them, and so they're fighting back. They're urging the members to write NASD and the SEC and withdraw this notice to the members. Claims that equity-linked annuities are not securities because they don't want the SEC regulating them. And I love this. I love this comment right here. They're not arguing equity-linked annuities are good. They're not arguing that they're good for some people. They're arguing that they're what? Suitable. What does suitable mean? There is a scenario where this product might make sense. Suitable doesn't mean it's the best product. It just means it's a product that could make sense. It might make sense in 0.2% of the scenarios we've run. 99.8% of the time, it wasn't a good product, but it's suitable because it made sense in a scenario. And they also argue that not all of the products being sold are horrible. There are some products out there that are good. This was my argument with USA when they were talking about equity-linked annuities. And I said, I'm going to quit if y'all do that, even though I've already announced my retirement. They would say, yo, our product's going to be good. And I said, there's no way you can make this product good because it's so expensive to create this thing. There's almost no way to make this product work out. Remember, the insurance industry is extremely expensive. You've got really expensive people working for them. They need to focus on products where they add value. And a lot of that has to do with life expectancy. You add value in the insurance industry when you pay people money if they die too early, or you pay them money if they live too long. This product doesn't do that. This product is an investment. The insurance industry cannot compete on pure investment products. It just doesn't work. So the argument that not all of them are horrible, my argument was they're not all horrible. USAA, you can sell a product, it won't be horrible, but it's still going to be worse than anything else they can buy outside of this product. So the argument that we have a horrible product, but it's not nearly as horrible as everybody else's doesn't work for me. And I don't know if USA sells them. I haven't seen them on their websites. So if they tried selling them, they haven't gotten it to work yet. So equity-linked annuities do not guarantee that you won't lose money. They do have a minimum rate of return, like 3%, probably lower today. But it's usually lower than what you get with treasuries. Today, treasuries are above 3% again. In fact, have y'all noticed treasuries here recently? I sent the text to my good friend who's a bond portfolio manager, and I said, can I send you a care package? It's just been horrible for bond managers this year. Interest rates are up like 170 basis points this year, just, or even more than that. Just ridiculous. Yeah, over 200 basis points. So I just said, the worst year ever for the bond market I can remember was 94. Interest rates were up about 275 basis points. We're up over 200 this year. It's just been a horrible year. So is that good for index linked annuities where if their guarantee is 2% and now you can buy treasuries for 3.5%? It's going to be a bit of an issue. The guaranteed rate return is usually applied only to the fraction of the amount you invested. Sometimes it's without compounding. On some contracts, no interest is credited unless you hold it maturity. So if you decide to change your mind, you're going to lose all of that. The other thing to remember, this thing is tied to the stock market. So you're thinking, hey, 3% is the worst I can do. So if the stock market crashes 30%, the most I can lose is 30%. I mean, it's 3%. I mean, I make 3%. That sounds really good to me. But what if you invest $100,000 and the stock market's up 30% that year? It's up 20% that year. And it falls 50% this year. And here's your guarantee. Do you feel like you lost money? So it falls to 78, but you're guaranteed you got 109. Do you feel like you lost money? You had $156,000. In year 3, you have $109,000. Do you feel like you lost money? Any of y'all say, oh, no, I did all right. I bet you anything. If you had $156,000 and a year later you have $109,000, you feel like you lost money. Most of y'all are going to feel like that, don't you? I think so. The insurance company says, no, you didn't. You made 3%. And here I compounded it. They're saying you're not even going to compound it. So they're saying it's going to be that. Oops, I messed that up. They're going to just say it's 106 and 109. So they're going to say you don't even get compounding. So I think you can lose money. I really do. And that's part of the way. But a lot of people are thinking, you know, if the market does really well, I get the upside. If it crashes, I don't most I can do is make 3%. All right. So what index is it priced off of? The universal index linked universal life policy I saw was actually priced off of 2 indices. So not only they make it complicated, but they double the complexity by adding 2 indices, the S&P 500 and the Dow. Why would you do the S&P and the Dow? It's like they just want to have more things to talk about, I guess. Really, really key. Does not include dividends. Extremely important. We'll show you how significant that is. The fraction of the index credited. So the participation rate, extremely important here. The participation rate tells you how much of the stock market do you actually participate in. That seems like that'd be really, really simple, but participation rates vary significantly and applied to different measures of index level changes. Participation rates are easy to compare, but they're not comparable. So if you're a marketer, you want to say we have 100% participation rate, because that sounds good, but 100% participation rate might be worse than another participation rate that might be 70% just because of the way it's calculated. That by itself should really bother you, right? If a company's picking its method so that you can advertise the highest participation rate, even though it's worse than somebody else's, that, you know, just kind of smoke and mirrors. So there's 3 formulas. There's the point-to-point method. From the level, index level from the beginning to the end of the contract term. Usually the contract's anniversary date and the index value is reset to ratchet up to reflect the credited return. A more complicated index is the monthly average return. So let's look at those. So you invested $100,000 and the stock market makes 1% a month. That's kind of nice. So there's your ending portfolio. You did pretty well, right? Oh, 1% a month. Well, I didn't do that well, but that sounds really good. So, and you've got 100% participation rates. So how much is the index? Well, the monthly average, here's your index. Did you participate 100%? You're going to credit. How do I send a letter to Zoom? You made 6%. What did the market do? Do you feel like you had 100% participation? You got 6.23% credited to your policy. Does that sound like 100% to you? Another company gives you 50%. So which was the better, 100% participation or 50%? 50% was slightly better. But if you're in a sales rep in a sales meeting and they say we have 100% participation, that sounds pretty good to me. The other guy said they want to do 50%. You see the deception here. Makes a big difference. So the more often the resets are, you're losing out because you're not getting that true index. I'll let you read the rest of those, but they're just saying what I just did there. Excluding dividends reduces returns by 64% over 30 years. Monthly averages reduces the price level index by 70%. It's like, where's my money? There's not much left, is there? So here's with dividends, here's without dividends, here's without dividends and monthly averaging. This is a 100% participation. Your $100 would have been $4,900. They're actually going to give you $544. Not a very good product, is it? So when I say they're not comparable, what I would say is they're comparable if you can get the sales rep to give you this. Wouldn't you want this? Just show me what the stock market would have done. Show me what this product would have done. This is what you need. What's the chance the sales rep's going to give you this? It's 0. You're better off investing in a lottery than you are to get that from the sales rep. Unsophisticated investors might believe they get 100% increase when in fact you're only getting 23%. Here's a shorter period. You can see it's still very significant. And if you actually calculate this is over 10 years, 183. Oops. It's only a 6.23% return or 63. The market was up 16.5%. You made 6.23% on an annual basis. Yeah, you're not making 100, and they're telling you you're getting 100% participation. And you're only getting 6.23% versus 16. So are any of y'all Googling to buy an index annuity right now? Am I selling you on this product? The gross credit calculated by multiplying index participation is then further reduced by spread because they had to cover their expenses. Lost 2 contracts linked to the same index with the same method, the same participation can have different returns. Then some firms put caps on it to say, we're going to give you 100% participation, but if the stock market's up more than X percent, we cap you at that. Is that material? That's hugely material, because what does the stock market do? It doesn't make 10%, 10%, 10%. It makes 30%, loses 10%, makes 8%, makes 18%. Those big years are really, really important. So caps reduce the crediting level. The effect of annual caps is dramatic, but the average return on stocks is heavily influenced by those high years. The annualized price appreciation in the S&P 500 was 10%. But if we cap at 14%, the appreciation drops almost in half. So caps can be massive as well. Equity index annuities are touted as excellent investments for investors wanting to participate in markets without bearing the risk. So let's compare it by just saying, hey, instead of doing equity index annuity, why don't you just buy treasuries and stocks and just be done with it? Something y'all understand that, don't you? Buy treasuries, buy a stock mutual fund. Everyone in here can do that. Have you ever bought a treasury before? How would you buy a treasury? You can just buy a treasury mutual fund, or you can go to Treasury Direct and buy it directly yourself. It's pretty simple to do. Would you understand that? Would you have trouble understanding that product? You got it in all your classes, very simple. If I told you I'll pay $1,000, you can explain buying treasuries into stocks or explain equity into annuity, which you want to do. I do the former, it's a lot easier. The comparison, they did 60,000 in treasuries and 40,000 in the S&P 500. 96.9% of the time, they were better off with the treasuries and the stocks. The expected value on the treasuries and the stocks was 219,000. Equity annuity came out at 186,000. The 33,000 equity shortfall was broken up of when the annuity did better, it was $219 better. When the stocks did better, they were $33,000 better. But that was overly generous because it assumed you held it to maturity. The stocks and bonds, you can transfer that around all you want to pretty easily. This equity annuity, if you change companies, the company you change from is going to penalize you harshly for changing your mind. So that's another thing. And then there's the tax treatment. A lot of those stock returns are capital gains. But with the equity annuity, you may be converting from a capital gain to ordinary tax. And the time they did this article, cap gains versus ordinary tax were very, very different. They're not quite as different today. So it's not as onerous. But that can be another major issue. There's interesting fee and expense twists. Equity index annuities, I keep calling it equity linked, sorry, do not have explicit annual fee or expense ratios. Instead, the insurance company makes money by giving investors less than the fair share. The insurance company, in our example, takes the dividends plus 50% of the capital appreciation. Equity index annuities are complicated investments sold to unsophisticated investors without the regulatory safeguards afforded to purchasers of similar investments. No registered rep, insurance broker, or retail investor, and precious few PhDs and finance PhDs could understand these products. The net result of equity index annuities is complex formulas. Hidden costs is that they survive as the most confiscatory investments sold to retail investors. How many equity index annuities do you think the author of this article owns? Probably not too many. Anybody want to argue the other side? I know I sound biased. I don't think I'm biased. I think I'm just telling you the truth. I hate these products. If any of y'all sell these, you want to make the argument, or you want to make the argument to me privately because you're, you think it's just too crazy. Some of your parents own these. You probably don't want to ask that question though, do you? But I assure you, some of your parents own this product. I'm worried that some of you own this product, but Some of your parents own this product, because how do I know that? Because these things sold just like gangbusters. They were, and they're still selling pretty well even today. All right, so what are we going to do with this? Let me show you what I want you to do for this next class, because this is pretty important. Under contents, miscellaneous materials, there's a file called equity linked annuity examples. So make sure you bring your calculator next class. Come on, you can do it. I don't know why it's not opening. If I click on it over and over again, I'm sure that helps. So you need to have this file open. So we're going to work through the math on this. I think 80%, 70%, 80% of students get close to 100% on this. A few students get almost nothing on this because they just have a brain freeze or something that they just can't do it. I don't think the math is all that difficult on this. I don't know why it's not opening. Everything's frozen. And it's 9 o'clock. What other classes are meeting that we're making this thing not? There can't be other students on. So I wish I could show you this file. I'm sure that's not helping either. So you need to open this. I just want to show you the math real quickly. Now we might before this need to do a quick options class. How many of y'all have never seen options in any classes yet? Is that a few of y'all? Do y'all know what an option is? Isaiah, have you heard of an option before? Have you ever bought one personally? Okay. Braden, have you done options before personally? All right, so I'll give you a little option background. We'll need it later too when we talked about straddles, short straddles. So we're going to do a SBDA, equity annuity. It's going to be $200,000. This looks exactly like the exam question. So there's no, if you can do this, and I'll give you some extra practice. In fact, you'll have extra practice because what I'll do is I'll work the exam question from last year and it'll be on the Zoom. So you have other problems you can practice with. All right. So we're going to set it up. We're going to do it how you would actually set it up yourself. So we're not going to do a true equity annuity. I'm going to show you what the insurance company is doing. And we're not going to do it like the article because essentially I'm setting this up where we give the customer everything. There's no caps. We're getting rid of dividends because we're doing an index option. So there's no dividends here. But this is kind of the best case scenario for the customer. We're going to give them everything we have. Okay. And we're going to price it. We're going to look at it. And you're going to notice that this looks a lot like a call option, looks a lot like a protected put. And we'll look at that and you'll see. I'm going to show you the math. I don't know how many of y'all have had put call parity before, but we'll look at it in put call parity and see how it all lines up. So this is where we're going with this. So make sure you have that file. If you wanted to kind of practice in advance, there's a YouTube that does this problem in advance. So we'll do this problem and we'll do a few other problems as well. So I have it on Zoom. I'll do at least 2 problems. I might do 3 just to give you some practice on them. The other thing we have out there is this article here. Let me do this. I'll finish this. This won't take us much. I'll let you a little early, but let me just real quickly. There was much this May, as they say here, that the SEC did not come in and regulate this. Some advisors are really upset that the court kind of shut this down. The U.S. Court of Appeals ordered the SEC rule to regulate equity index annuities to be vacated. Index annuities remain under the regulation of state insurance. Some advisors say that means inappropriate sales of products. Says the new suitability model developed by the NEIC offered additional protections, but probably not. The products sometimes carry high commissions. Agents have been criticized for inappropriate. Now, we talked about this earlier. If the commissions are high, think about it. You walk into an insurance company, you give them $200,000. They take 20,000 of your money and they hand it to a sales rep. They only have $180,000 in their money. How can they possibly give you a good return on that? Are they going to say, well, let's pretend like we have $200,000 in their money and we'll give them a full return? They can't do that. They only have 180,000 of your dollars. So that means you're already behind by 10%. It's just the only way it can work. There's no magic the insurance company can do to make up for that $20,000 they just gave to the sales rep. So you just know it's not going to work. They pushed them hard to elderly. The Financial Planning Coalition group said in a statement that they were disappointed. So you can see there's a battle here between the insurance industry and other investment groups. Many equity-linked annuities carry very high commissions, have very long surrender periods. So that means if you change your mind after 10 years, you're still going to be penalized heavily. 14% commissions. So I use a 10% commission. Think about a 14% commission. There's no way you can come out ahead on this product because they're giving 14% of your money away. How many of y'all would buy a front-end load mutual fund that charges a 14% sales commission up front? You know there's no way you can win that battle. This firm said so much is already being done that adding another layer of regulation, they're saying, hey, don't give us more regulators. We already have too many regulators. So we're going to keep ripping off our customers. Let us keep ripping them off. Just don't throw another regulator on top of that. This guy says he has never sold and would never sell this type of annuity. I've studied them with great interest. He says, I cannot represent a client that he's going to participate because he's not going to get the stock market. He's going to get minus signs and a cap. So the NEIC has come in and they put further burden on the company to make sure, not to make the products better, but just make the sales rep more honest. But remember the sales reps. How many regulators are sitting there with the sales rep when they're sitting in the living room selling these products? So, you know, this industry has some shady practice. I get back to my argument. I'll see what y'all say on the exam. You cannot sell these products when there's commissions involved. I think commissions either have to go completely away or the commissions have to be exactly the same for every product. That's my argument. If y'all disagree with me on that, I want to hear your argument. Okay, so you see there's a big debate here. The insurance industry is saying, hey, we make a lot of money on these. We want to keep doing it. Other people are saying, you're making us look bad. All right, so y'all see we're going to next class. We're going to work through this problem.